Hello, everyone, and a very warm welcome. In this session of Fundamentals, a platform to understand your fund tenets, we discuss Axis Bluechip Fund. This fund is the biggest large cap funds in the industry with an enviable assets under management of 35,000 crores and a vintage of over 12 years. This fund has been able to generate a return of 12.34% annualized since inception. To put things into perspective, a large cap fund has to invest 80% of its holdings in equity and equity related instruments of the top 100 companies. In spite of this constraint, the fund has been able to generate an alpha over its benchmark. Today, we have with us the mind behind this fund. We have Shreyash Devalkar to help us understand this fund better. Thank you, Shreyash, for joining in. We really value your time.
Thank you very much.
So, to begin with, my first question to you is about the investment framework and the philosophy with which you manage the Axis Blue Chip Fund.
Axis Bluechip Fund, as the name suggests and the category suggests, is a large cap fund. Here, at Axis, irrespective of fund category, we follow quality and growth as a philosophy. I'll just delve more into it. If you notice that by quality, you can talk about various qualitative parameters like value addition, like competitive advantage. So these are more of a qualitative parameters to assess, apart from obviously corporate governance, which is remains a hygiene factor. Whether the companies are taking decisions in the interest of minority shareholders. So these are the typical way to qualitatively assess a company. But more important is these parameters need to get reflected into quantitative parameters, and that's where the typical parameters like return on equity, return on capital employed, more importantly, free cash flow generation. What is the free cash flow generation to PAT? That is a profit after tax. That gives you indication of how profitable is the company and whether the quality of the cash flow is good or not. Actually, all these parameter gets reflected in the valuation of that company when it gets traded in the market, and that's where these parameters remain important for us, and we follow this quality in this manner in our fund. When it comes to growth, then when it comes to especially Access Blue Chip Fund, since it is a large cap fund, one need to always look at how much is the growth of the companies which you intend to own, and how much is it compared to the Nifty's growth. Probably BSE 100 is the benchmark for such funds. So how much is the growth compared to the underlying benchmark? And benchmark probably remains important here in the large cap category, because if you notice the stocks in the large cap benchmarks are relatively concentrated versus weightages in a say typical mid cap benchmark. So we need to look at how much is the growth of say Nifty or BSE 100 companies, and then whichever companies you are owning, whether that company can deliver growth higher than the overall growth of the underlying benchmark. So that we think is a good recipe to try to generate alpha, that whether the companies which you own are growing faster than underlying benchmark or not. So this is how the growth works, and always it is about relative, because we have seen that multiple times earning is upgraded or even it gets downgraded. The point is the earnings in your holding, whether they are getting upgraded faster or higher, or they are getting, if the cycle is opposite, because economic cycle can be positive, it can be negative. So if the earning gates are getting downgraded, then whether the downgrades are happening more in the funds, in the companies which you are owning. So these are the typical parameters one need to watch out for when you are investing into various companies in this fund.
Right, Shreyash. So, Shreyash, my next question to you is that, a portfolio construction depends on two parameters. One, you have to choose your sectors, and then you have to choose the stocks within those sectors. So, can you give us an example of any of the sectors that you own in the portfolios and the reason why you're either overweight or underweight in one of them? Right.
Sure. So if you notice, there are multiple sectors in this fund, and in the large cap category, one of the large sector is financial services, consumption oriented themes. So I'll just give you what one should look at or what we look at while choosing some of these sectors. So if you notice, financial sector services, which is also high weightages in underlying benchmark as well as our fund. One of the way to look at financial services is its growth is broadly correlated to GDP growth or economic growth. But in that, that's what I said, that while explaining the philosophy or what we try to do, whether companies or whether in that sector, whatever you want to own, whether that growth is faster than the underlying economy or not. And now, if you just try to bifurcate the growth, the credit growth of India, uh, then the credit growth comprises of two elements. One is retail credit growth, other is corporate credit growth. The if you notice, uh, last 5 year, 10 year, 15-year period, especially last 5 to 10 year period, that retail credit growth has been faster than the corporate credit growth for various reasons. There are multiple reasons for this, that why corporate credit growth has been slower versus retail credit growth. So when you choose, then one need to look at the retail credit growth, how it is happening, which are the segments of retail which are doing well, and which are the companies which may benefit from that. So this is the thought process you apply while choosing or selecting a company in a particular sector, say a financial services. When it comes to consumption sector, again, if we see, everyone knows about India's consumption growth story. In this long-term growth story, there are various products which may be more penetrated or already many people using it, and there is only at the most premiumization story left into it. While one need to look at sectors or segments in this consumption story also, which are having higher delta growth than the overall market. And such segments you can find out from the penetration story, or especially the earning class getting richer, and that's where the consumption of and that process being faster, whether the consumption of more expensive items or the consumptions so just to give you example, in autos, whether two-wheeler growth is faster than four-wheeler growth. So one need to look at all those items and see that whether there is underlying theme into it or not, and accordingly you choose sectors. Then those sectors can be in auto, it can be in retail industry, it can be anywhere. So this is the thought process what we use while choosing a particular company in retail sector. So again, the same thing, whether the companies are growing faster than the underlying sector, and what are the drivers for it, how much is the room to grow, and what is their right to grow. So the company have a high right to grow, then they find their ways to grow by launching new products and so on. And that's how we try to select it in this fund.
Right, Shreya. So just taking this point further, it has been largely spoken about that the Axis Bluechip Fund designed with a growth perspective in mind. So, what is the reason of having a growth-oriented mindset vis-a-vis choosing companies with a lower PE or a lower PB ratio, or a typical value style of investing?
What we observed is, if you take long-term wealth creation, then generally earnings growth or compounding of earning growth has resulted into higher returns or capital appreciation. So that has been happening for long term. Now, if you take growth oriented, and that in growth also, see, it's not that the less p stock or less value stock, they don't grow. Actually there also you make return, but when they grow, and whether that growth is sustainable and whether it is compounding or not, that becomes a key differentiator. So for that matter, if just to give example of the metal sector gave you phenomenal returns in last year, and it was on the back of higher earning growth led by higher metal prices. Now, whether the call to be taken here is whether it is a 1 year phenomena or it is a multi-year compounding story. So when we try to choose companies, and when I spoke about sectors, talked about 5 year, 10 year CAGR compounding stories. And when you look at that, then what happens is, even if the stories, even if there is a error of judgment on the valuation front, over period the earning growth catches up, and you can generate your returns post that. There may be mismatch for some time, but obviously you need to keep on checking whether that compounding of growth is happening or not. So we try to focus on this. On the other hand, if you talk about other sectors which are probably relatively cheaper, but if there is no compounding story, and if the growth is going to be for 1 year or two because of some cyclicality or short-term things, again, I don't want to use the term cyclicality, because it's not that cyclical stories are not compounding. It is just that uh, their cycles are probably 3 to 5 year, and for last 2 years there may be decline in earning. But as long as the cycles are long term, even there you make money. But if the stories are mostly dependent on price increase, sudden price increase, which mostly has happened earlier in commodities, then one need to be more careful about those. And that's where we generally try to look at structural growth stories. And historically in India, generally, if you notice in the market, their valuation has been higher than the underlying market valuation.
While investors often get lured by returns, the risk often gets missed. So, to an investor coming into your fund, what would be the time horizon you would suggest, and what could be the return expectations?
So, in a large cap category, especially, the returns expectation and a time horizon is normally here. One need to look at from 3 to 5 to 10 year perspective. And large cap companies are mostly are more economy related. And because of that, here what we have observed is the large cap or the large cap indices returns are closer to nominal GDP growth of a country. So that is what one normally look forward to when one try to invest in a large cap category. Again, because they are large cap, they are more associated. Their growth is more dependent on economy, because there the relatively penetration stories may be less compared to mid and small cap, and that's where the returns of large caps are more closer to economic growth. But at the same time, since you spoke about risk, since these companies are established, they became large cap because they were earlier small or mid, and they had their journey and path from failures to successes. And because of that, generally what you observe is larger companies have lesser volatility in their earnings, and that also reflects in the appreciation of the prices, so with lesser volatility. So in that sense, one can look at these as a lesser volatility compared to mid and small. So that's where these are the things one need to look at when or keep in mind when you're looking at large cap category.
Right. So, Ashish, coming specifically to the size of the fund, Axis Blue Chip Fund with an AUM of 35,000 crores is the biggest large cap fund in the industry. Now, if I look at your portfolio, it at the best comprises only 40 stocks. So, how do you manage concentration given the size of the fund?
So the way I look at it is by the definition, what is large cap? A large cap is top 100 stock by market cap. So there itself your broader universe gets defined. It's that you can have around 20% in mid or small, but 80% or large bulk of it need to be in a larger cap, which is again a top 100. So if you when you are selecting a portfolio from the say a set of 100, uh, then uh, then I have tried to choose probably 35, 40s, that kind of number. So basically that is a selection, you can say, from that 100. And other part is, if you notice the market cap or of the market cap of 100th company, then you will notice that, and the largest market cap in India. So their market caps are much bigger than the fund size itself. And that's where this fund, actually, if you notice that, uh, if you restrict yourself to top 100 and a large cap category, uh, and there are multiple opportunities there. As I said, that there are multiple opportunities in various sectors in this, and these companies are also another way to look at it is that blue chip companies, because as the name suggests, because they're there in the economy for years altogether. So all in all, for this category, I think this universe of 100 is good, and out of that, choosing 35, 40 stock is a reasonable bet to take.
Right. So, Shreyash, my next question to you is that, when you're running such a growth oriented strategy, you can have periods of underperformance like the one that we are witnessing right now. So, how should an investor understand risk return of this portfolio in different market cycles?
So, if you notice the performance of this fund, and actually more than that, if you try to assess how this fund have behaved uh, over cycles, then what I explained was that quality and growth. If you go by this as a philosophy, then you will notice that most of the companies which are structural growth stories are, and with less cyclicality, are in the B2C space. Uh, this fund, and when I say B2C, it includes retail credit growth, it includes consumption, it includes everything in that. So when you look at this as a theme, or this as a majority driver for stock selection, then whenever B2C as a segment has done well, or consumption as a segment has done well, broadly during that time, you will notice that this kind of strategy would have done well. So this is how I am just looking at it. And if I try to look at historically time periods, when, and try to cut down on which time period B2C has done well. So that is one of the observation.
Right. So, Shreyash, I'm sure this is one of the best funds in the industry in our view as well. But I'm sure there would have been some incidents along the way where a few sectoral calls or a stock calls would have gone wrong. Could you help us with any few examples of one of the sectors you would have taken a wrong call or that would have gone wrong or contrary to your expectations?
Sure. So normally when you look at even what has gone right or what has gone wrong when we assess, so we keep on assessing this. There are multiple ways to assess it. So the way we assess it is, there are two errors when you build a portfolio. One is error of commission, and another is error of omission. That is, what you buy has fallen, and order of omission is what you don't buy has gone up. In the first case, when we select any stock, then we try to, especially since it's a blue chip, then in the blue chip category, you try to select companies which are having track record, long-term good management, good corporate governance. So by that, you try to avoid the risk of commission in this. But there can be time periods, the way you are highlighting, that uh, that a particular segment has not done. So probably one of the observation has been that post-COVID market, the way market rallied, uh, for multiple reasons. Consumption as a story didn't work out. The reasons are multiple. One is it had an income impact, unfortunately, on the people because of various supply constraint. It had an impact on the margin profile because the raw material prices went up. First it was because of the supply constraint uh, led by lockdowns. After that, geopolitical tensions, war, so multiple such things added to it. And that's where some of these B2C company could not have done well. So this is how we try to assess that what could be the reasons for this, and then how to plug this and how to improve on this, and whether uh, something which is working well now that they're coming back to the error of omission, what you don't own, whether it is doing well or not. So there also you try to assess whether the stories which you are missing, whether it has a compounding element into it or not, or are you missing that part of it. So when we try to assess that, then probably I gave you example of one of the commodity cycle. So commodities went up sharply, but then some of them or many of them also has come down. Probably barring oil, most of the commodities are down, like aluminum and all. So one need to look at those elements that which are not playing out or which are playing out. So considering all this, we keep on assessing the portfolio and make changes whatever are warranted under our philosophy.
Right. So, Shish, my final question to you is about the construct of the team. While we know you as a fund manager, and if you could help us understand about the research team, the compliance team, etc., which support you in delivering the kind of returns you do for this particular fund.
Yeah, definitely. Obviously, it is not a one man or one person who drive. First, starting with the investment team. So in the investment team, we are so there are four fund managers, including head of equity. So head of equity, you are aware already. Already is handling multiple funds. Then we have a small cap fund manager who is also handling multiple funds. Then there is one more who handles some hybrid and other funds. So there are fund managers, and then there are analysts. The analysts are actually having good experience of more than 8 to 10 years in the respective sectors, and they are tracking it over years. So uh, more important part here becomes that the thought process, the quality and growth as a thought process and philosophy. So broadly that is ingrained in our fellow fund managers as well as analysts. So that's where that also helps all of us as a fund manager in selecting particular stock for the fund based on its mandate. And those stocks are then selected in various funds based on whatever mandate that fund may have. It may be large, multi-cap, flexi-cap, small cap, or diversified fund like long term and all. So this is how the investment team works with a similar kind of ability to assess the company uh, with the underlying philosophy of the company. Now, obviously, there are various risk limits which you need to manage while managing the fund, and there is able team of both compliance and risk. They then assess various risk when it comes to fund. It may be liquidity, it may be exposures, it may be many things. So those things are also assessed by various teams within the company. And then we have meetings in which it gets discussed. So there is a proper process behind all these things. So it's a team effort, definitely, rather than one person.
Thank you, Shreyash, for answering all our questions very patiently. This brings us to the end of our discussion. I'm sure our investors are going to find it equally enriching. Thank you so much for your time.